This is the Advanced Forex course for Smart Traders 2.0. It's lesson 12, how to monitor and improve your trading performance. And I'm Sam Eder. Now that you've built your trading system, it's time to talk about how to track your performance and how to keep improving over time. In this lesson, I'm going to show you a simple and practical way to track your trades without spending hours each day doing it. Oh yeah, let's dive in. To monitor your system's performance, you want to keep it simple. We'll focus on just a few key metrics which you'll be familiar with from lesson 4 on setting objectives. These are your returns, your drawdowns, your win rate, your risk reward, your expectancy, and we'll also cover efficiency. These are all easy to track, and we've included a free spreadsheet in the MarketMates resource pack. Now remember, you're not trying to build the perfect system. The goal isn't some flawless holy grail strategy. What you want is a system that meets your objectives, fits your personality, and suits your lifestyle. A system you can trade consistently without making mistakes is more valuable than something high performing that you just can't stick to. So don't worry about trading like a hedge fund superstar, just find what works for you. The next point is you don't need to manually record everything. Your platform is going to handle a lot of it, and there's trade journaling software that will help too, that integrates directly with your trading platform. But what these platforms don't normally track, and what you do, is your R multiples. That's the amount you've made or lost on the trade compared to your risk. For example, if you risked $100 on a trade and it hit your stop loss, you lost $100, you'd have lost 1 R. If you'd made $300 on the same trade, then you would have made 3 R, 3 times $100. So here's an example of what tracking your R multiples look like. For example, there was a -1 R trade on the 30th of March, then a +3 R trade on the 31st. And don't worry, our spreadsheet calculates all this for you. You just need to plug in the dollar amount and the risk amount, and it's going to calculate what your R multiples were. I also recommend adding in a screenshot of each trade. I use TradingView for this. It's an easy way to go back and review things visually later on. You can see an example here of using the long and short positioning tool on the chart. Once you've got a decent number of trades, it's time to assess if your system is meeting its objectives. You'll need somewhere between 20 to 100 trades before the data tells you anything meaningful. But note, this isn't really like a statistically significant number. But you do need to start somewhere, and it's unreasonable to expect you to record thousands of trades before you start reviewing the results. So I'd say around like 20 is pretty good. If you're a short-term trader, maybe a little bit more. And be aware of recency bias. This is changing your strategy too quickly based on recent performance. So you look at the past few trades and you think, okay, that didn't work, I need to change things. Now you can compare your actual results against your original objectives. You want to be tracking your returns and your drawdowns, and you want to do this in 2 ways. So one is a percentage, like your system's made 20%, and 2 in terms of R multiples. Okay, your system made 20 R. So both are useful, and together they give you a clearer picture of your performance. You can also look at these stats over a day, a week, a month, or a year, etc. It depends what's relevant to you and your trading strategy. Of course, you want to track your win rate, but just remember your win rate is not the most important metric. What actually matters is how much you make when you win compared to how much you lose on a losing trade. That's a lot more important than win rate. And a lot of high performing trading strategies actually have very low win rates because they have a very good risk reward ratio. And of course, this risk reward ratio is one of the things you want to track. So I like to track the average risk reward ratio. So that's the average of your winners compared to your losers. And a lot of your system development efforts will be focused on improving your risk reward ratio. Often, again, more important than trying to improve your win rate. Next, you want to check if your system is generating the right number of trades. So in my experience, traders often make a big mistake here. They will have goals in terms of their returns and their maximum loss, and then they'll trade way more trades than what they actually need to given the position size they have. So make sure that you've defined this clearly in your objectives at the start, how many trades you're going to take, and then track how many trades your system is actually taking, because we want to avoid over trading. In lesson 3, we covered expectancy. So this is how much you can expect to make on average for every trade the system makes. So for example, if you did 10 trades and you made $1,000, your expectancy would be $100. And I like to look at expectancy instead of in terms of dollar amounts, in terms of R multiples. And Van Tharp has a way of ranking system performance based on the expectancy in terms of R multiples. You can see here on this table above 1.5 is excellent, Between 0.6 and 1.5 is very good. Between 0.2 and 0.5 is good. And of course, if your expectancy is below 0, it means you don't have a profitable system. And just remember here, good is good enough. You don't need to chase the perfect strategy. If you have an expectancy above 0.5 and a system you can trade well, then that's all you really need. Okay, now let's take a deeper look at the R multiples. The distribution and sequence of your R multiples can tell you a lot. Here is a table that shows you your R multiple distribution. For example, say you've got a string of -1R losses, then suddenly a +6R or a +23R win. This is important because it shows you that your system needs you to stay in the game long enough to catch the big trades. So basically, once you understand this, you're not going to freak out over a few losing trades because you know that that's what is required for your system to meet its expected performance over time. Next, we want to look at market types. When we're looking at market types, we're trying to understand how a system is going to perform in different market conditions. So when we know this, we can make decisions like, okay, I'm only going to trade in certain market conditions, or I'm going to change my position size in more favorable market conditions. So next we want to track mistakes. This is efficiency that I talked about before. So remember, mistakes are not losing trades. Losing trades are a normal part of trading. A mistake is where you don't follow your rules or follow your plan. So how we do this using efficiency is we track the percentage of trades that you take where you make no mistake. So this is pretty easy. So for example, if you place 10 trades and you make one mistake, then you've got an expectancy of 90%. If you place 100 trades and you make 15 mistakes, you've got an expectancy of 85%. Okay, so what we're looking to do here is have an expectancy of above 90%. So that's the key. If your expectancy is below 90%, then that's probably the first area you need to go work on. Make sure you can actually follow your rules. Figure out what it is that's stopping you from following your rules. Often it might be a psychology thing, but sometimes you're just trying to do too much. Now, what do you do if your system's not hitting your goals? If your system's not meeting your goals, it's ultimately very simple. You want to figure out what's working and what's not working so you can do more of what's working and do less of what's not working. So that's our simple objective here. So the way we do this is we place our trades following our rules, and then we make small logical tweaks along the way, but like a scientist conducting a science experiment. Like you change one or two variables over time and you assess how those variables impacted performance. So when you're doing this and reviewing your performance, here's a list of questions that you can ask yourself. Is your trade objective clearly defined? Is your stop loss too tight or too wide? Are your setups giving you an edge? Are your entries consistent and repeatable? Are you cutting your profits too early, or are you letting winning trades turn into losing trades? Are you risking the right amount based on your conviction in the trade? Are you trading at the right time of day or week? And what is the impact of news events or different market conditions having on your trades? Okay, so this might seem like quite a lot. So to bring it all together and keep it simple and under control, I suggest you follow what I call a monthly improvement plan. So here's an example of how one might work. So month one, you work on your stops and you assess whether your stop is too tight or too far away. Month two, maybe you add a trailing stop and see how that impacts performance. Month three, you work on your exit strategy. Month four, you work on how news impacts your trades. Next month, you might work on your entries and if having a different entry method is going to improve your trades. So you just follow this process month over month over month. And eventually you're going to end up, as I said, do more of what works and less of what doesn't work. Now, the interesting thing that's going to happen if you do this for a period of time is you're going to end up with this big set of previous trades. And what you can do when you decide to make a change to your trading strategy is you just go back and you apply that change to your previous trades. It's a little bit like back testing, but using actual live trades that you've placed in the past. And you'll find this extremely helpful because these are real trades that you've actually placed, and it's very different than going back and theoretically testing a set of data of trades that you've never actually placed. You have a completely different set of insights. Now, another tip I find very useful is going back and trying to understand why the trades worked out the way they did. So for example, what happened to your trade during a central bank rate decision, or what happened when market conditions changed, or what happened to your trade when a correlated market did something. So what happened to your FX trade when the equity market went down, for example. So go back and try to understand the reason why the trade played out why it did. This lesson focused on the metrics you can use to monitor your performance and some different ways you can make changes to your system in order to improve things. Now just keep it simple, keep it practical. You do this by focusing on the objectives that you've set out at the start, and you're trying to make improvements to move your system closer and closer to achieving those objectives. Obviously, during this process, it's really important that you record every single trade, because when you do that, every single trade becomes a learning experience, and that's what's ultimately going to allow you to grow and become the trader you want to be. Okay, in the next lesson, we're going to take a step back from system development, and we're going to talk about how to treat your trading like a business. I'll see you there.